Well, happy Saturday, everybody. What a crazy week we've had, haven't we? Today, I'm going to talk not about stocks. I'm going to talk about refinancing because one of the things that's happened is that our federal rates have been cut. Both in Canada and the US, prime rates have dropped down, and refinancing a mortgage is something that is a totally viable option for people on both sides of the border. Now, as you guys know, I'm a Canadian, and our mortgages work surprisingly different than American mortgages. We don't have the option of having like 15-year fixed mortgages or 30-year fixed mortgages, and we have to renegotiate our mortgages every couple of years. Now, because I'm Canadian, I'm not super familiar with American mortgages, and one of my subscribers asked me a question about refinancing, and it was pretty specific, and she was kind enough to provide me with a ton of details, and I was able to delve right into American mortgages and find out so much information. So I have built a brand new spreadsheet that does a comparison, and it allows for comparing mortgages that we have now compared to a new mortgage that we might be thinking about opening. And I've set it up in a way that it can handle either Canadian or American mortgages, because what I've done is I've included columns such as escrow and mortgage insurance. And what these are individual line by line, month by month data entry. And I'll show you how simple it is. I've tried to set it up in a really great way so that it allows people to analyze a mortgage and decide whether refinancing is a good option. Welcome back. This is Drawbridge Finance. My name is Levi Woods. This is an opinion channel about money. And today we're talking all about refinancing mortgages. If you don't already subscribe, you probably should. Turn on the notifications bell when you do so you get all my updates. I do these videos because they're an important part of personal finance, and we have to be informed because we have to make decisions that make the most sense in our own personal circumstance. Now, I make tons of different spreadsheets. They're available on my Etsy store. This one, of course, is going to be on Etsy. And as well, I'm going to release it as a bonus for my patrons this month. So anybody that's already a patron, look for it in the digital download section. I mean, I always upload a digital file every single month, but I've already done a digital download for the month of March, which is still available. So this is actually a second download available for patrons until the end of March. And then in April, I'll have a new file available for people. Anyways, let's get right into this. I tend to go overboard with some of these charts, and this one is right on track for being a little bit overboard. It gives a ton of information. So I'm going to really systematically go through how to fill it out, and hopefully that kind of gives you guys an idea of how to use it. And then we'll look at some of the data that I've provided at the bottom. I'm going to go through kind of left to right down the chart and hit all the data points that are important in filling this out. In this particular case, I'm going to use real data from a real situation. Once we open up the chart, you can see there's three columns. There's a gray column on the left, which is going to be our current mortgage situation. Then there's going to be two mortgage choices. So mortgage choice 1 and mortgage choice 2, and they're just designated by different colors. The first thing we're going to do is we're going to put in the loan amount. Now, this amount is not the original loan amount. This is actually the current outstanding mortgage balance. What we're going to do is allow this chart to generate the data going forward as if this was month zero. So we need a couple of things that we need to know. So the first thing is the outstanding balance, $130,935.66. We fill that out and it starts to auto-populate some of the chart already. Now, the next thing we're going to do is the interest rate. So the interest rate is 4.87. Now, the number of remaining months in the term. So in this particular mortgage, there's 330 months left in a mortgage that was originally 360 or 30 years. So we're going to type in 330. Now, this is where my chart is slightly different than some of my other charts. It's going to involve putting in escrow or property taxes, which are technically not part of your mortgage. It's just that in the United States and for some mortgages in Canada, people actually pay their property taxes as part of their mortgage payment. So this chart actually combines the two and allows us to look at the total monthly payment of everything. So we're looking at the mortgage principal payment, the mortgage interest, any extra payment that we're making to the mortgage principal, mortgage insurance, and escrow, which is a combination of property taxes and property insurance. Now, this is the interesting thing about this particular spreadsheet is because I was trying to figure out a way to analyze this so that we could compare apples to apples. So what this is doing is actually not comparing what the mortgage savings are, the interest savings, but actually the cost of owning the home and running that home over a 30-year period. Because when a mortgage is completed, we would have to continue paying property taxes. And if we assume that that's part of our normal mortgage payment, then what happens when the house is actually paid off, that those payments are just reduced. Instead of being $1,200 a month, maybe we're paying less. We're paying a couple $100 for the property insurance and property taxes. And that's what this chart actually does. So in this case, the escrow, property taxes, and insurance works out to $376. It automatically populates this escrow column down, $376. The other things that have started to fill out here are the interest payment. The portion of the payment that's made each month that's going to the mortgage is going to be $721, and that gets split between the interest and the principal. And then the escrow $376 is here. Now you'll notice in this column, the extra payment is negative $1,097. You'll also notice that the principal is red. All this denotes is that the principal payment is less than the interest. It means when we make a normal mortgage payment, more of it is going to interest than it is going to principal. And that is something that I don't personally want to do. When I make a payment, I want most of it to go to principal. And we can do that by making extra payments. You'll notice that in the extra payment column, it's actually negative and it's red. All the cells are red. Anytime, if you see a caution symbol in this, or if you see a cell that is filled out red, it means the data is not yet entered or there's an error in the data that has been entered and there needs to be a change. I've tried to make this spreadsheet as foolproof as possible to aid you guys in entering the data because it is a bit complex. So the first thing we need to do is how much do we normally pay to the mortgage? Now, her normal payment, including escrow, is around $1,100, but she told me that she always rounds up and pays $1,200. So that's what we're going to put in here, $1,200. And you'll see that in this first month, it automatically calculates out. So now we can see how that $1,200 is divided. We've got $531 going to interest, $189 going to principal, $376 going to escrow, and the extra payment is $102.85, which is technically an additional on top of this principal. So those two combined are both paying down principal. Now you'll notice that the mortgage insurance column is blank. Now this is where the flexibility of the chart comes in. In this particular case, there is no mortgage insurance being paid, so I'm going to leave it blank, but you can just data enter any white cell. That's how my charts always work because any other cell is auto-calculating. So just the white cells need data entry. So you could put a 0 in here, but it's not necessary. If it's blank, it's counted as 0. So the total monthly payment is $1,200. Now the easiest thing to do is just to grab this in numbers and just scroll down. This chart is quite long. It's 360 cells long. I'm going to pull this down to month 279. And you'll see what happens is on the right-hand side, this balance owing is decreasing as we go down, and all of a sudden these cells light up red. As well, the cells on the left side light up red. And what has happened is the chart realizes that if you continue to make a $1,200 payment and there's only $200 still outstanding on the balance of the loan, that obviously you don't want to pay that. Your last payment is going to be smaller than $1,200. So we have to delete any information in the total monthly payment column that is next to a red cell. So we're going to take that and we're just going to delete some of those. Now it's going to actually put data red cells to the left of it. And all we have to do is type in what this last payment is. So the extra payment is negative $606.08. I tried to keep this super simple for you guys. So I'm going to type in 606.08. And then you can see now that month 234, that final payment will be $606.08, and the mortgage balance owing will be 0. Now after that, all that is required is we have to pay the property taxes. So the payment will drop down to $376, which is what the property taxes are. So I'm just going to take this $376 and I'm going to drag that down to the very bottom of the chart. As soon as I've done that, it'll make all these calculations, and now everything's zeroed out and we can see what our total monthly payment is. Now the reason that I've done the chart in this way is because A lot of finance people out there are saying like, you're going to save so much money on your mortgage and you're going to cut down and you're going to save all this money by making these huge extra payments. And the reality is that we still have to pay property taxes. And so we should look at it on a whole and say, how much is this building or this home going to cost us over the next 30 years? And then we can compare different scenarios, because just because the mortgage is paid off doesn't mean that we actually have zero cost per month. And that's why I've included it. Now, if you don't want to use the property taxes, all you have to do is just change this value to zero in this box here, and then subtract it from the monthly payment. So in this case, instead of $1,200, it would be $1,200 minus $376. All right, now that all that information is filled out, we can just scroll down to the bottom and we can see some things that are happening. So at the top, it shows the full term payments of $237,980 and the full term interest at $107,000. Now, because in this scenario, making these small extra payments of $102 per month, they add up to a lot of money. The total interest is $61,000 compared to $107,000. That's a $45,000 savings in interest. That is a lot. And that is the power of compounding. Making those small extra payments will do a lot over the course of the loan. But that's only one part of it. We know that that's the path that she's currently on. What we want to know is what happens if we refinance. Now, there's two scenarios she's asked me to run. There's a 15-year 2.5 fixed rate mortgage, or a 30-year 3.14. Now, the unfortunate thing about refinancing a mortgage is that there's a penalty to close the mortgage that you're currently in. Now, in this case, it's around $7,000. I've got the exact figure, but what it does is after the closing fees of the first mortgage, it means that whatever new mortgage at the new rate is financed at has a greater starting balance. So we're going to start by filling that out. So we'll look at the very top of the chart again, and mortgage choice one, we're going to fill this out as if it was a 15-year mortgage. It's going to be $138,265, and the interest rate, as I said, was going to be 2.5%, and the terms is going to be 180 months or 15 years. The chart's automatically going to calculate out the monthly mortgage payment, and all we have to do is fill out these columns. Now, the very first thing is that if she refinances, it brings the value of the balance owing up to more than 80% of the value of her home, so she's going to have to pay mortgage insurance. I'm going to fill that out. Mortgage insurance, $46 for the first 36 months. Now, the monthly payment is going to be $1,343. Now, in this case, the $1,343 is actually greater than the $1,200 on this side. This is a comparison chart. The whole idea with this is I want to compare $1,200 to $1,200 so that we can make a fair comparison, comparing apples to apples. So if I put in $1,200 here, you'll see that this cell is still red. It means that without increasing her monthly expenses, she won't be able to get this mortgage at 2.5%. She would have to bring the value of her monthly contribution up to greater than $1,343. I will do that for sure, but I'm not going to do it in this particular chart. I'm going to make a copy of it and I'm going to change the parameters so we can compare apples to apples. So for now, I'm going to move on to the second mortgage choice, which should work. Now, the second one is going to have that same loan amount, $138,265. The interest rate is going to be 3.14%. And the term is this one's going to be 360. So extending the duration by an extra 30 months. So you can see the principal here, the principal payment would be less than the interest. So it is red text, but that is fine. It's this column that we're concerned about. If it's red, it is wrong. Now, is there mortgage insurance? Yes, there is. Unfortunately, if she refinances, she will be paying mortgage insurance. And this one is for quite a long time. $46 paid for 88 months. Now, this is information that you get from your mortgage broker when you actually phone them and sit down. They'll provide you with this information on a piece of paper when you ask for a quote. So if we take a look at month 88, that will be the final $46 mortgage insurance payment. So now we can fill out this total monthly payment column. Now, again, we want to keep apples to apples, and the chart is designed to do so. So if I enter any number other than 1,200, because that's what we've got in this column, it will return red. So I'll just show you how that works. So if I try to put 1,300 in here, it will light up the cell red. So what we want to do is put in $1,200. We're going to drag it down And because this mortgage rate is lower, it should pay off the loan sooner, even though the value is greater. Now, all of a sudden you can see some cells that are lighting up green. Now this starts in month 66 in this particular scenario. Now what I've done is I've designed this chart so that it will tell you when the balance of the potential mortgage is less than the value of the current mortgage if you stayed on the present course. So just to show you what it's comparing, it's this value over here, $107,135 is greater than $107,077. Therefore, this cell lights up green. Any of the other previous months, if we did a line comparison in month 55, the value here at 111 is less than the value owing here of 112. So all we're going to do is we're just going to continue to pull this down. All right, we can see down here at month 219, it is going to light up red on the outside, and it's because we've made an overpayment. The total owing the previous month was only $399.19. So if we delete this, it should show us the total payment owing, which is $775.72. So we just type that in, $775.72, and then that should give a zero balance. And then this next column, $376 ongoing. Again, this is because of the property taxes, and they will go on as long as we own the home. So that's why I've included in here, because we're trying to figure out the total cost of the house over the 30 years. And then we can do an actual comparison. So now this 376 is going to get pulled down all the way to the bottom of this chart. Same as we did in column 1. Everything is now filled out correctly. So now we can do a proper comparison. We can look line by line, month by month. And that's the reason why I've designed this chart like this, because sometimes your insurance changes or the monthly payment that you make changes. And you can do that and kind of track the mortgage as you go and really customize it to whatever your situation is. So the balance owing, that's the big thing, because we're trying to pay down the loan. So let's look at the bottom. To live in the home for 30 years, with the current mortgage, the total payments are going to be $327,000. Now, if she was able to refinance at 3.14% and continue making a $1,200 a month payment, she would pay a total of $315,391. You can see there's actually not that big a difference. The total difference is right here. It's $12,000. That's the difference between $315 that she pays in mortgage choice 2 relative to the current mortgage. The interest saved is $23,000, but that is what a lot of people focus on, and it's not really the best thing to focus on, because although she saved $23,000 in interest, she actually still paid another $11,000 in payments that weren't really included, because people just assume that there's zero payments for that property once the mortgage is paid off, which is absolutely not true. So we have to look at total cost of owning that home. Even though the reality is, even though there's $23,000 in interest saved, the total savings is actually only $12,000. Now, that's not really a lot when you amortize that over 30 years. In fact, I've broken it down. So this would be the interest and the mortgage insurance paid. In this other scenario, she would only pay $13,000. So she's had an additional savings of $4,000, which is an average monthly savings of $118. And then we can look at that year by year. Now, the reason that I included this and kind of broke it out is because it changes over time. In the end, you're not really saving anything. That led me to a really interesting conclusion on this. But before I get to that, I want to show you just a copy of this chart looking at what if she theoretically increased her payment to cover that potential 15-year mortgage, and if that would be a good savings. What I've done is I've made a copy, and in this first column, instead of putting $1,200 with what she's currently paying, I'm saying, okay, hypothetically, what happens if she increases the monthly payment to $1,344? Now, by doing that, you have to make sure that you can afford that. Now, one thing to take into consideration is this actually includes an extra payment per month of $246. So without defaulting or anything crazy on her mortgage, she could actually reduce this monthly payment down by $246 at any time without penalty. And that is kind of a great thing to note, in that you have that flexibility with this particular scenario with her current mortgage. Now, in mortgage choice 1, her monthly payment would be the same, $1,344 compared to $1,344, but it would all be going to what is necessary, her necessary payment. Because she's put on this aggressive mortgage with this newer, lower rate, she has to make this higher payment. And that higher payment, so she's literally making 6 cents of extra payment up until month 36, at which point she would have $46 of extra payment. So at any time, if money was tight, she would not have any ability to reduce that mortgage payment. She would be stuck for the lifetime of the loan paying around $1,300, $1,344 for the first 3 years, and then around $1,300 would be she would have to maintain that right until the end of the 15-year period. So I think that that's a little bit risky to do that personally, but I don't really know her situation. Maybe she's got that extra $150 more than she's currently paying, and that's really easy for her to be able to afford. Now let's look at mortgage choice 2 and just compare. So making this $1,300 payment is going to pay down this mortgage scenario faster as well. You can see I've just left these the same. The only thing we've done is we've changed the monthly payment from $1,200 to $1,344. And what that does is allows us to go down to the bottom of this chart and do a comparison. Again, I want to look at total cost. With the current mortgage, it would be $316,000. If she ran a 15-year mortgage with these high payments that have no flexibility, she could get her payments down and pay only $293,000. That's a total savings of $22,000. Again, not even $1,000 a year. Here's the breakdown. And it's interesting that she saves more in years 4 to 6 than in 1 to 3 on a monthly basis. And that's because of the property insurance that she has to pay. Now you can see why this is so complex and why I built this specific chart for this. So we're comparing 316 to 293 or to 309. So in this situation, you would still have some money saved, a total savings of $7,000. Now, $7,000 is not chump change. And mortgage choice 2 actually allows for a lot of flexibility. The total monthly payment would be $1,344, but it could be reduced by up to $328 at any point without penalty, which would mean if there was financial crisis of any sort or something personal came up, there would be the flexibility of being able to reduce the mortgage payment on the monthly basis, which I think is kind of a nice safety net. I mean, I know what's going on in the world right now. I know I've got a mortgage that I can afford, and I hate to see people looking at mortgages that they can't afford. So that's one of the most important things about any financial planning is knowing what you can actually afford. So we'll just take a quick rundown on this, because one thing I want to show you that I thought was an interesting outcome from this is what the balance owing in this mortgage choice 2 is greater up until month 71. Now that's almost 6 years, but it brings up an interesting point, because at any point in time when you sell a home, you have to pay off this mortgage, and there's a penalty in doing so. So it makes me think, well, if I was in this situation and I knew that I was going to move within 5 years, I mean, I probably wouldn't go for mortgage choice 2, because although it seems to save me money over a 30-year period, the reality is this extra $7,000 that I would have to do to refinance right now actually adds to the balance owing and means that when I sell the home, I'm going to have to pay a bigger penalty to pay off the mortgage when I sell it. So in that case, if I knew that I was going to sell or move, say in like the next 2.5 years, I would want to pick the mortgage that gave me the smallest remaining balance, and that would be this current mortgage situation. I definitely would not be looking at mortgage choice 1, which is the 15-year mortgage. Say I was going to be in the house for 5 years, then I might determine that it would be best to switch to mortgage choice 1 and have these aggressive payments and know that I wouldn't be able to skip any payments or reduce my payment structure at all for the next 5 years, but I would have the lowest balance when I sold the house. Now, if I wasn't going to sell, if I was going to be in this house for 10 years, obviously it makes the most sense to switch to mortgage choice 2, which is the 30-year mortgage, pay this slightly lower interest rate, have flexibility, and eventually be paying down the balance owing by a greater amount. Now, I know this is a huge amount of information, and I think that everybody that's going through this has to be able to fill this out, and that's why I've made these available, these charts in different forms. So any of my $7 a month or greater patrons are available to download this for the month of March. And now this is in addition to the other digital file that's already available. So any patrons that sign up during month get 2 digital downloads this month. Otherwise, it's available on my Etsy store. You guys can check that out. I've got links in the description. I'll probably put a link right up here so you can click over there directly. And I hope that this helps shed some light on some choices as to whether or not it is actually a good idea to refinance or not. I hope you guys learned something today. I know I did building this chart. It was a ton of fun, and I love finances so much. I hope you guys do too, because that's how we're going to get rich together. Thanks so much for watching, and see you very soon.